Please confirm if you can see my screen. Can you see my screen?
No.
No, sir.
No, no,
No,
sir, your screen is not showing. Your screen is not showing.
no, sir.
All right, no problem. So I'm trying to send the YouTube link to the group. Can you see it now? Can you confirm if you can see it now?
Yes, we can see it.
Yes, I can see your screen.
I can't see the screen. No.
I can't see the screen, sir.
It's visible clearly.
No, I
It's
can't
not
see
showing.
it. I'm not even seeing anything. No.
It's not
can
showing.
It's showing, no, it's showing. Maybe it's from your end. Maybe network is bad from your end. It's showing.
It's showing. Maybe it's your network.
I can't see anything.
So you're all welcome. If you can't see my screen, that will be maybe network issue from the side. So you're welcome to today's class, as I've said. So we stop at question 3. Have we solved this question? This particular past question. That the source of borrowing comprises of both specific source and general source. Can you please confirm if we have solved this question in the class? Hello?
We've not solved it all.
No, we have not solved it. No.
I think we have solved this question that day.
It's something similar, but
The one
Yes?
we solved is question number 1. That one for APL.
We have solved this one. We have
yes.
solved this pretty something too. We have solved this one
Yes,
too.
we solved it, but I did not include it in the Excel sheet that you sent for us.
I did not do what?
You did not include it in the Excel sheet that you sent
Everything
to the
is on
chat.
the Excel sheet. Everything is there. We will need to change the sheets under this place. So we have question 2 under Q2 here, question 3 under Q3, and we have the question 1 under Q1 here. Everything is there.
Okay, sir.
Yes, sir. So let's quickly look at this last question. This one is the past question. and it's comprised of some of the likely sources of borrowing to finance the capital expenditure. Can we please mute our mic, please? Let's mute our mic. So I don't want to move everyone. So in case you want to ask question as we go on, please let's mute our mic. Let me look for the question. Since the solution.
Question number 5, sir.
I will not hear any audio here.
So I think it's this 2019, May 2019. Did this one.
Number 5, sir. Number 5.
Number 5, okay. Okay, November 2014. So let's go through the question together. In accordance with IFRS13 borrowing costs, that's borrowing costs that are directly attributable to acquisition, construction, or production of the qualifying asset form part of the cost of the asset, while other borrowing costs are recognized as an expense. In accordance with IFRS13, borrowing costs that are directly attributable to the acquisition, construction, or production of the qualifying asset form part of the cost of that asset, while other borrowing costs are recognized as an expense. Required. State the condition where in capitalization of borrowing costs, commence, should be suspended, and should cease. We have all these in our notes. Everything is in our notes. So the B part, Vitamax PLC is constructing a factory that will take about 18 months to complete. The company commenced construction on 2nd of January 2013. The following payments were made during the year. These are the following payments that were made during the year. Then we have first payment of 31st was funded from company pool of debt. However, the company succeeded in raising medium-term loan notes for an amount of 160 million on 31st March 2013 at a simple interest rate of 9% per year, calculated and payable monthly in arrears. These funds were specifically used for the construction. Excess funds were temporarily invested at 6% monthly in arrears and payable in cash. The pool of debt were again used for a 40 million payment on 30 November, which could be funded from the medium-term loan note. The construction project was temporarily halted for 3 weeks in May 2013, where substantial technical and administrative work was carried out. The following amount of debt were outstanding at reporting date of 31st December 2013. We have medium loan notes, we have bank overdraft, and we also have 10% 7 years notes with simple interest payable annually. For the bank overdraft, the weighted average amount outstanding during the year was 150 million, and the total interest charged by the bank amounted to 6,760,000 for the year required. Calculate the total amount of interest to be capitalized. All working should be to the nearest 1,000. So basically what they asked us to do here, like we have explained for the past 2 weeks, qualifying capital expenditure, these are the assets of the company, or these are the projects that a company embark on that is going to take a substantial time before they can be completed. So those are the quality of the qualifying assets. It's going to take a substantial time. Just like we have it here, it's going to take them 18 months to complete the construction. And as we have it in IFRS13, there are likely different sources of finance that the company might opted for. There are different sources of finance that the company may decide to use. They can decide to use a specific sources of finance. What do I mean by specific sources of finance? Specific sources of finance is a situation whereby the company approach a particular financial house and borrow purposely from that single source to finance a particular project. The company stand up, approach any bank, borrow at an agreed rate, and they use that particular fund, that particular single source of finance to finance the project. And also the company can... What do you say? Can you hear me? And also the company can decide to use a pool of funds. What does that mean by a pool of funds? A pool of funds is a situation whereby the company have more than a single sources of finance. Just like we have it here, they have a medium-term loan, they have bank overdraft, they have 7%, 7 years no note. All these are different sources of finance that the company decided to use to finance their projects. So if this is the So if the company decided to use different sources of finance, just like we have it under this question, so they have multiple sources that they decided to finance their project from. In this situation, it's not something that we can just decide that, okay, let's use this particular rate as our finance cost rate. In this situation, in line with IFRS13, we are going to calculate our weighted average cost of capital. And to calculate our weighted average cost of capital, we are going to add all our finance costs together, divided by the total fund we borrow. Doing so, we multiply our answer by 100. So we are going to have our weighted average cost of capital, which will be used as the rate of interest payable on any fund we withdraw from the pool of fund. Be with me. There's pool of fund, there's specific fund. If the company is financing a project from a specific fund, that one is very straightforward. There could have been an agreed rate, 5%, 10%, very straightforward. But if a company is financing a project from a pool of funds, that means that they will have multiple sources of finance with different finance cost rates, with different interest rates. Doing so, for every money that the company takes out for that pool of funds, which comprises of different sources of finance with different interest rates, the company will need to calculate the weighted average cost of capital of all these sources of finance in order for them to arrive at the specific interest rate that they will use to get the amount of the finance cost to be paid. So we have the solution here in my notes. I've sent the solution to the class, but for the purpose of those that they are just joining us, I'm going to resend the solution again. So this is the solution. We have the commencement of the capitalization, expenditure for assets have been incurred. Okay, I'm trying to solve the A part here. We have it in our notes already. So now the B part. To calculate our work, we are going to do the total interest plus bank overdraft divided by total fund plus bank overdraft multiplied by 100. The reason why we're having bank overdraft separate here is because if we check the question, they have given us the total interest rate, the total interest figure of our bank overdraft, which means that we don't need to use any rate to calculate the interest portion of the bank overdraft. We have it here in the question that for the bank overdraft, the weighted average amount outstanding during the year was 150 million, and the total interest charge, the interest charge is 6,760,000. So they have given us the interest charge directly already. So that is why we need to add the interest on the bank overdraft plus every sources of financing interest, which is what we did here. Here is it. So this is the total interest plus bank overdraft. Here is it. How do we get this total interest? We get this total interest Sorry, I think I have the working somewhere. So this 180 million is how we get it. Let's look at the formula again. The total interest. What do you mean by the total interest? It means that for every sources of finance that we have, we are going to multiply the interest rate multiplied by the total fund that we borrow. Interest rate multiplied by the total fund that we borrow. The addition of all this interest plus bank overdraft is what gives us this 186 million. While the addition of the actual fund that we are paying this interest of 186 million from is what gives us this 1,950 million. So division of this divided by this multiplied by 100 is what gives us this rate. This is it here. Let me see if I have the breakdown of this. I think I have the breakdown of this thing somewhere. So I want to explain how we get the total interest. So total interest that we have there is we get it by multiplying all these sources of finance. This is the total amount we borrow, and this is the interest rate here. For this one, this is it. We multiply this 10% with this. Let me try and solve it for us so that you can have clarity around it. Hold on, I'm trying to solve that the breakdown of that 180 million so that we can have the clarity around it. Hold on. So I just want to show us the breakdown of this 180 million. So I've even put it here. This is it here. So going by our formula that total interest plus bank overdraft divided by total fund. So what they mean by total interest is the sources of finance that we borrow from. That sources of finance, the interest rates we agree. We are using a pool of funds. Each interest rate multiplied by the total fund borrowed. That is what gives us this 180 million. So we only have 1.8 billion multiplied by 10%, which is what we have there in the question here. We have it here. This is it here. So this is one of our sources of finance that we have an actual interest rate being attached to it. So we are going to multiply this 10% multiplied by this plus the bank overdraft. We should have looked for the rate of this bank overdraft to multiply it also. But for the fact that they have given us the total interest for the bank overdraft already, which is 6,760,000. So that is why we add the 6,760,000 plus this. So it assumes that every sources of finance that we wanted to calculate, they have done that on our behalf, and they have given us the total interest paid. So that is why we add this interest paid plus this 180 here, and we have this. Then the sources that we are paying this from, this is the total fund we borrowed. The sources we are paying this from, this is the total fund we borrow from them too. So the addition of these two gave us this. Now, let's go back to the formulas that say that total interest plus the bank overdraft divided by total fund plus bank overdraft. This is why we arrive at this 9.58 here. After getting our 9.58, we now have an interest rate that we can use to charge every fund that we take from our pool of funds. Pool of fund comprises of different sources of fund that we borrow from. Pool of fund is the sources of fund that have more than one source. The pool of fund have multiple sources of finance. In order for us not to be biased, okay, we borrow from company A with a particular finance rate, with a particular interest rate. We borrow from company B with a particular interest rate. We borrow from company C with a particular interest rate. That becoming a pool of fund. For us to have a single interest rate we are going to use to charge all these sources of finance, we need to get our WACC, which is what we did here. Our WACC will now be the addition of all these interest rates divided by the addition of all the interest divided by the addition of all the total fund, which is what gives us this 9.58. What does this mean? It means that for every fund that we take out from that pool of funds, we are going to use this 9.58 as the interest rate on it. Now let's go back to the question. We are told that these are the steps, or these are the stages of withdrawing from Vitamas PLC. So the first payment of 31st of January, which is this, funded from the company pool of debt. Funded from the company pool of debt. And don't forget that we now have the rate for every fund that we take from the pool of debt to be 9.58, which is the reason why we use 9.58 to multiply this 40 million. We use 9.58 to multiply this 40 million. Now, let me explain this operation to us. This operation occurs as a result of the fact that, I told you in our last class that if our sources of fund, if our sources of borrowing is from a specific fund, irrespective of the time that we withdraw it, we are going to maintain the actual months from the days that the fund is being made available till when we complete the project. Irrespective of when we withdraw it, we are going to maintain that month's proration, which means that there won't be any form of prorating when we are borrowing from a specific fund. But if you are borrowing from a pool of funds, we are going to consider when do we withdraw the fund. When do we withdraw the fund? Let me take that again. If our sources of finance is from a specific fund, it's from a specific sources of finance, not from a pool of funds, we are not going to prorate as at when we withdraw the money. We are going to use a 12-month straight agreement. But if our sources of finance is from a pool of funds, we are going to prorate based on the time we withdraw the fund, which is the reason why we are having 11 divided by 12 here. How do we arrive at 11? The bond fund is being withdrawn on 31st of January, which means that January is not part of the month that we used that particular fund. So we invariably we withdraw that fund as at the end of January. So we now need to count from February, March, April, May, June, July, August, September, October, November, December. That is how we arrive at this 11. So we are going to do the multiplication to get our total interest rate. So on this particular fund, this is the interest rate we will pay on it. Now, the second drawing of the company on March 30. Let's check where did they withdraw that from. However, the company succeeded in raising medium-time loan note for an interest of 160 million on 31st at a simple interest rate of 9%, calculated and payable monthly in arrears. These funds specifically used for construction. Excess funds were temporarily invested. This is the investment income. We are going to get to that. In arrears and payable in cash. The pool of debt were again used for 40 million. You see, this second drawing, 40 million, that will be when? On 30 November 2013, which is this last one here. 40 million is also for pool of fund, which could not be funded from the medium-time loan note. The construction project was temporarily altered. So basically what they are trying to tell us here, the medium-time loan note here is the only specific sources of fund that the company had, which is what they explained to you. However, the company succeeded in raising a medium-time loan note for an amount of 160 million on 31st March 2013 at a simple interest rate of 9%, which means, except this first 40 million that we are told specifically is from a pool of funds, and this second drawing that we are also told from that the sources of this is also from a pool of funds. Every other drawing here, they are from specific sources of finance. They are from this medium-time loan note. So the company have 3 sources of finance here. They have a bank overdraft and they also have 10% loan note. However, after obtaining these 2 sources of finance, they also approach another bank for a specific sources of finance, which is this medium-time loan note, which we are told here that is at the rate of 9%. So every drawing, except the first and the last, we are from that specific pool of funds, which is the reason why we multiply them with 9%. And if you notice, irrespective of the time that we withdraw the fund, we maintain 9/12, which is when the fund was made available from the question. You see, 31st of March, which means we are going to calculate the fund was made available as a 31st of March. So we are starting from April, May, June, July, August, September, October, November, December. That is 9 months. It means that the fund was made available to us for the period of 9 months. So that is how we arrive at the 9% multiplied by the every other sources of finance, multiplied by the months that the fund is being made available till the end of the project, which is December. And this is the last drawing from the pool of funds. We are told about this specifically from the question that on November 30, another 40 million was being withdrawn from the pool of funds at the rate of 9.5%, which is the percentage that we calculated using our WACC. So this surplus investment, and explain to us that it's possible that if the company borrow a particular fund, either from pool of fund or from a specific fund, the company will not use the total fund at a go. The company will not use the total fund as a go at a go. So for the first drawing, as at that first drawing, the remaining fund is being kept on a short-term investment, which earned them 6% return on a short-term investment, which means that until second drawing, that first drawing will be the only one we have with us. The second drawing, the third drawing, the first drawing, and the one that we draw on the 30th of November, as at the first drawing, every drawing is being kept on the short-term investment. So that short-term investment that they kept that money on with unused fund, on the unused fund, the short-term investment that they kept it, that is how we arrive at this surplus investment. See, drawing on the 30th of June, drawing on 31st of October, and the one on 30th of November. So this short-term investment is going to be an income to us, which we can also use to reduce our total interest before we now arrive at the actual interest we are going to pay. Now we are asked to show the value of the asset. Now the value of the asset will now be the addition of all our drawing plus the interest cost we paid on them, which is this 240 million 240 billion 391 million 797,436. So that brings us to the end of this particular solution. So I'm going to open the floor now. If you have any question, so that we can ask before we quickly brush up the IFRS 13.
Hello, sir. Good evening, sir.
Good evening.
Okay, I have a question, sir.
Okay.
My question is this: is the work only applicable to borrowing from pool of fund only?
Is the what?
Is the work formula?
Yes,
is it
yes.
applicable to only
Yes,
borrowing
yes.
from pool of fund?
Pool of fund only, yes.
Okay, sir.
Yes.
Thank you.
And if you check how we get our work rate, you will see that we make use of all the interest payable to all the sources of pool of fund divided by the total fund borrow from all this pool of fund. So what is the percentage you are going to use to get the interest rate for every fund we withdraw from the pool of fund only? Thank you very much, Juan, for that question.
Hello, sir.
So let me call the next person.
Hello, sir. Thank you for your class.
Please, your voice is sounding very far.
Hello, sir. Can you hear me, sir?
Yes, I can hear you.
Okay, I want to know, how did you know the ones that are borrowed from pool of fund and the ones that are specific? Because when I was following you class and I didn't really get it.
All right. Thank you very much. Let's look at this question together. They have given us the
You are muted, oh, you are muted, sir.
sorry. So from the question, the following here, which is that all the payment, these are by the company. Then that to us that the first payment of the first January was funded to the company of that pool of
Your voice is cracking, sir. I don't hear something.
Your voice is cracking, sir. Your voice is cracking. I'm not even hearing anything at all. I don't know if I'm the only one experiencing it.
If you can hear me now.
Is anyone hearing me? His voice is cracking. Let me know it from my side.
Keep quiet. We can hear you now. Allow him. He's asking, can anybody hear me now?
Oh, God, don't tell me keep quiet. Please don't try it again.
Why will you be telling her to keep quiet? That's
I
wrong.
don't understand. Why you telling me to keep quiet?
It's not professional. Now, why will you tell somebody to keep quiet? It's wrong.
Sorry. That. I am clearly now. I am me clearly now.
Breaking.
The network is bad.
Your line is breaking. Really, really breaking.
It's still breaking.
Right. Let me to another. Confirm it is fine now.
The network is still breaking. I think the breaking is from the facilitator. Then other members, if they are talking, the network is okay.
I think same too. I think same too. When other members are talking, we kind of hear them. But when the facilitator wants to talk, we barely hear him.
I think we lost him.
Please, am I the only one not seeing the screen?
You are not the only one. In fact,
We lost him. He's no
from the
longer
beginning,
here.
I've not been. That's what I wanted to raise before. I've not been seeing the screen since when we started. Just now that I just saw the screen and it's no more again.
I was saying this thing, it's just now that I asked questions that the thing started
So if you've not been seeing his screen since we started, then it's in your network. If you've not been seeing his screen since we started, then you need to check yourself. Your network. His screen just went away, not quite well.
Wow, that's serious. I've not been seeing the screen since the beginning. I was just hearing the conversation.
and this topic is important to go. I'm just tired like this.
Don't be tired. Let's wait for him.
Let's just be patient.
Not everyone. The class still continue.
If it's not available, someone who knows the answer to it, please help us.
Please, let's just be patient and wait for him.
I was trying to say that if he's not around, who knows the thing should be helping us, please, so that we'll learn.
Can you confirm if you can hear me?
Yes, we can hear you.
Hope
We can hear you.
it's better now.
I think so.
Very much better.
So sorry, I think the service is fluctuating somehow. I'm sorry for what happened the other time. So we are just trying to the man that said that statement does not mean it that way. Please, I'm very sorry about that. So I think the question was, how do we know if the company is withdrawing from a specific source of fund or a pool of fund? Can you see my screen?
No, yeah,
My
No,
screen.
sir.
No, sir.
no, sir.
Service is very
So it seems the
poor. So
network in your area there is very poor. Maybe if you can change your position.
yes, I don't know why it's open. I've received my screen trying to come. So let me. Can you hear me?
Yes, we can hear you, sir.
Can you hear me? Okay.
Your
So
voice
just
is
continue
breaking
to
due
the
to
screen will
network.
come.
Can't hear you. Your voice is breaking.
Yes, your voice is breaking, sir. I think the network is bad.
All right. How is it now? Can you confirm if you can hear me clearly?
Yes, we can hear you now.
It's fine now,
Very
right?
well.
We can hear
All
you
right.
clearly now.
All right. All right. So
But the screen is still not coming up, sir.
it will come up now. You see it now. You should be seeing it now. So we are told that the first payment on 31st January was funded from company pool of fund. And we are also told that after that, the company succeeded in raising a medium-term loan note for an amount of 160 million at 9% simple interest rate. Also, they told us that the pool of debt were again used for 40 million payments on 30 November 2013. So that is how we know that, okay, out of all these drawing that the company did during the year, all this one 40, 90, 20, 40, 50, there were actually two sources of them that were from pool of funds, which is this one and this first one. And the interpretation is that the 50 million drawing we have in November year, this one here, 40 million from it is from pool of fund, while 10 million is from specific fund, which is what we did here in our solution. See it here, 40, 10, the same date, fifth drawing, pool of fund, specific fund. Do you have any other question, please? I hope that answered the question from the madam that asked.
Yes.
All
That
right.
50, was it in the question?
Okay,
Like you
so
read it in the question.
Which
I'm
one?
barely hearing
Which
what
one?
you are saying.
That was
50 and 10. Is it in the question? Like you read it from the question, right?
okay. This is it from the question. Let me show you. Look at this 30 November. Do you see 50 here?
Yes.
Can you see
Yes.
this 50, 30 of November?
Yes.
Oh yeah, next check this place. The pool of debt were again used for 40 million payments on 30th of November, which could not be funded from the medium-term loan note. And we saw withdrawing of 50. We are told that 40 is from pool of fund because they could not use the medium loan to fund the total 50, which means that 40 from pool of fund and 10 from specific fund. I don't know if you get me. This is the reason why we break it down here. You are welcome, man. You are welcome. So do you have any other question? Madam Anoshika Funaya.
Yes, sir. Good evening, sir. Thank you very much for tonight, sir.
Good evening, ma.
So I have a little confusion in that work formula. Hello, sir. You hear me?
Yeah, I can hear you now. Your voice is breaking before.
Oh, it's just this network. Can I say that?
Madam Funaya, I'm listening.
Okay, so I want to ask a question on the work formula. Like you said in the formula is the total interest over the bank overdraft plus the total funds over the bank overdraft multiplied by 100.
Yes.
So I want to know, how do you know which bank overdraft to use for the total interest and which bank overdraft to use for the total fund?
Okay. Let's look at the
Hello,
question
sir.
again.
Okay.
Again, let's look at the question. So this is the question here. Look at the sources of funds. We have medium-term loans, we have bank overdrafts, and we have 10% 7 years notes with simple interest payable annually at 31st December. You get. Now let's check through the question. Look at that last paragraph. Here is it here. For the bank overdraft, the weighted average amount outstanding during the year was 150 million, and the total interest charged by the bank amounted to 6,760,000. We are told that the total amount outstanding, which means from this total of 240, the outstanding balance is 150, and this is the total interest. So, and we said our formula for work is what? Interest paid divided by total amount borrowed, which means that 240 was borrowed at the rate of a specific rate that did not give us, but they give us the total interest figure, which is 6,760,000. So this is the total fund 240, and this is the interest paid on it, 6 million. I don't know if you get it, man.
I'm trying to.
Do you get what I'm saying?
I'm trying to, sir.
All right, let me take it again. Let me take you. You asked me that, how do we know the bank overdrafts and how do we know the interest that we are going to add to work? Is that not the question?
Yes, sir.
Now, very fine and good. The first thing to know is that how many sources of fund do we have in this question? We have two. Basically, we have three. Two, they are under pool of fund, while there is a single one that stands separate. Look at the question here. The payment on 31st January was funded from company pool of debt, which means that the pool of debt has already been in existence as at this 31st January. However, the company succeeded in raising medium-term loan note for an amount of 160 million, which means that this medium-term loan note is separately from the pool of funds that the company have with them already.
Okay.
They now say that on 31st March 2013, at a simple interest rate of 9%, calculated payable in arrears, this fund was specifically used for the construction. They make it clear to us that this 160 million is a specific fund, not a pool of funds. Who is that? Do you have any question? Who is that?
Off your mic now, beg. Let me know if I can get this in, Jerry.
So we are told that this fund was specifically used for construction, which means that the 160 million is from a specific sources of fund and it's been specifically used for that project. And it's different from the pool of fund that the company had in existence as at 31st January. The pool of debt were again used for 40 million payment, which could not be funded from the medium-term loan note. You should know that from this, that they are trying to let us know that the medium-term loan note is different from the pool of funds. Then I went ahead to give us the breakdown of that pool of funds that they are talking about. The following amount of debt were outstanding at reporting date. Medium-term loan note, which is the specific fund that they told us, 160 million. Bank overdraft, 240 million. 10% loan, 7 years loan note, 1,800,000. It's actually billion because we add 30. 1,800,000, which means the addition of our pool of fund comprised of bank overdraft and this 10 years and this 10% 7 years loan note. Now, then I went ahead for the bank overdraft, the actual formula for WACC. Let's put aside that I said plus the bank overdraft. Sometimes, if they did not give us these 6 million figures, they will give us the rate of that bank overdraft. If you are given the rate of that bank overdraft, it means that we are going to apply that rate on this 240 million to get our interest, which is what we will use to add together with this 180 million here. We get this 180 million by multiplying 10% to 1.8 billion loan notes. So the total loan is 1.8 billion at the rate of 10%. The multiplication of this 10% and this is what gives us this 180. The bank overdraft, because they did not give us the rate, but however, they give us the total figure already. And if they give us the rate, we are not going to use this. What we are going to use is the rate multiplied by that 240 million, which is the total bank overdraft. But for the fact that they did not give us the rate, what they did is that they give us the actual rate, actual figure. So we just went ahead to add the actual figure to the 180 million, this is the total interest from the pool of fund. And this is the total fund that comprise the pool of fund. So we are told that the outstanding as of December is 150. And we have this to be 1.8 billion. So that is why we add this together to get the total fund divided by this total interest. Let's check this again. We are told here that for the bank overdraft, the weighted average amount outstanding is 150 billion. This is the total fund. But as at this December, this is the outstanding amount. During the year that the qualifying capital expenditure is being constructed, this is the outstanding amount. It means that it's from this 150 million that we withdraw our first 40 and that last 40 that they withdraw, not for these 240. They have used this 240 in the preceding year. Why the current year? Now what they have left for that project is 150 million. So it's from this 150 million now that we withdraw our first 40 and the last 40. So if you want to calculate our WACC, we are using the 150 million as the total fund of the bank overdraft and this 6 million as the interest we are going to pay on this 150. I don't know if that answers your question. Man.
Yes, sir. Yes, sir. Thank you so much, sir. It's quite clear now. Thank you so much, sir.
All right. So, do you still have any other question? No question. Is there any other question on this borrowing cost? So no question. Let's quickly brush through this IFRS 13 and we call it a day. So there is another past question that deal with borrowing costs. You can as well practice it based on this experience, based on this knowledge. Also read out the notes. The question can be in theory and in workings, just like we have it here. This question was being tested in 2019. So let's look at IFRS 13. So it's one of these short and simple IFRS. So IFRS 13 talk about fair value measurement. So fair value measurement is the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Basically, what this IFRS 13 is telling us that for us to know that this thing is at the fair value rate, the market participants that want to transact, both the buyer and the seller, must be someone that are very knowledgeable about the business. Not that party A is a novice, while party B is a professional. At that kind of transaction, the transaction is not being transacted at arm's length because either of the party is unaware about the scenario, about how things is being done. So it assumes that there won't be any form of fair value in that scenario. But in a situation whereby the both party are very much aware about the transaction, they have the knowledge of the transaction, they know what it takes to transact at that moment, that means everything that will be transacted upon is going to be at fair value. So we have some key terms. You have the exit price, which will be what will be received to sell an asset or paid to transfer a liability. The price the market participants are willing to pay is the exit price. The winning price is the company specific price. The entry price is the company specific price. We also have ordinary transaction. This implies that the transaction must follow the normal rules, regulation, procedure, and therefore the transaction must not be forced sales transaction, which means either of the party must not be under duress. Either of the party must not be under duress. Both parties must have clear knowledge and must be at their free mind, must be transacting willingly, not because one party needs to do that as a result of being threatened or not. So, if that is the case, the party that is been doing that transaction under duress will not be able to quote the actual value of that particular commodity that has been transacted. But for a transaction to be at arm's length, none of the party must be under duress. Both parties must be knowledgeable and have clear mind about the transaction. A transaction under duress, participants are compelled to transact. So they are trying to explain the meaning of transactions that are not orderly transactions. That's a transaction under duress, a forced transaction, a transaction that the seller was required to sell in order to meet legal or statutory requirements. If that is the case, the seller does not have negotiating power on their side again because there is a targeted obligation that must be met. It's different from I'm willing to do it at any time I want to do it. Not that I have an obligation that is now a conditional obligation that must be met within a specific period of time, which means for me to meet up that obligation, I must be ready to let go of that commodity at any price. So for that price we meet up with the obligation I want to settle, I'm less concerned maybe the price is the fair value price of that particular commodity we are transacting at the moment. So transaction where one part is in or near bankruptcy is also similar to the previous one, which means either of that party is doing that transaction under duress, under on free mind. So we have market participants. These are buyers and sellers. They must have the following characteristics. They are independent from each other. They are knowledgeable about the asset or liability. They are able to enter the transaction and they are willing to enter the transaction. We also have the measurement date, the date in which the fair value of the asset or liability is determined. So we have where we can apply fair value. We have the PPE, we have the financial instruments, IFRS9, we have investment property, IS40, we'll be looking at it. We have intangible assets, which is IES, is that not 38 or 37? We also have biological assets, IS41. We have business combination, which is the group account. We have the current asset held for sales and discontinued operation, IFRS5. That will be our next discussion next week by God's grace, IFRS5. The current asset held for sales and discontinued operation. So, measurement of fair value. Because fair value is the market-based measurement. Fair value is measured using the assumption that the market participant will use when pricing the asset. Therefore, it is assumed that the transaction to sell the asset or liability take place in either a principal market or with advantageous market. Those are the two types of markets where fair value has been used. So they went further to explain what they mean by the principal market. The principal market is the market where assets, this is the market for the asset where greatest volume and level of activities for an asset take place in an ordinary transaction. Under this market, the value of an asset is amount received less its transport cost. So The principal market is a market where we have a very large volume level of activities. There is a lot of buying and selling. There is a lot. So before we can call a market a principal market, there will be a very large volume of activities taking place at that particular market. And the fair value price will be the fair value amount less its transportation cost. We also have the most advantageous market. This is the market that maximizes the net amount that will be received to sell an asset. Under this market, fair value of an asset is the amount received less transaction cost and transport cost. So there is a clear difference between principal market and most advantageous market. Just from their name, principal market is a market whereby there will be more like an open market where we have a very large volume of transactions taking place. While most advantageous market is a market where the market that maximizes the net amount that will be received to sell an asset. And to get our fair value in the principal market, we need to consider our transport cost alone. But in the most advantageous market, we need to consider both the transport cost and the transaction cost before we can arrive at our fair value. Which means, from the value of an asset, we are going to less our transaction cost and our transport cost. We also have highest and best approach. What do they mean by highest and best approach? Before we can say that this is a fair value of an asset, how do you arrive at that fair value? How do you arrive at it? So I said this is a method of valuing non-financial assets. It's a measurement basis used by market participants that would maximize the value of asset or group of asset and liability. In determining the highest and best use of non-financial assets, the following must be considered: physical possible, legal permissible, financially feasible. These are the quality that must be present before we can say that, oh, this is the best approach used in determining the value of an asset. Before we can say, okay, this fair value is actually a reasonable value, not an assumption from one party against the other. So we have the fair value hierarchy. What do they mean by fair value hierarchy? Before we can call it, okay, this is the fair value of a particular asset, there is the hierarchy in it. There are some stages that we can use in determining the fair value amount. The level 1, input for a quoted price. These are the quoted price in the active market for identical assets or liabilities. Example of quoted price of shares traded on stock exchange. What do they mean by input of a quoted price? It means that asset of the same category, you can use the value of asset A to know that, okay, so far asset A is this value, asset B can also be this value because they are of the same category. So that is level 1 input. Asset of the same category, using the fair value of the one that we know to determine the one we did not know. But because they are of the same category, we use it for one another. Level 2, input for a quoted price. These are inputs other than the quoted price for identical or assets or similar assets in the market. So the quoted price, for quoted price, there is a particular asset that we know that, okay, this is a price, this is a market value price on it. So we now use that market value price to determine the one we did not know, but because they've been thrown to the same category. But for level 2, there is no unquoted price. If there is no price being quoted in the market, but however, in a general terms, there is a specific market value to it, but it is not quoted. It is adjusted price. Like the value of a car now, for the fact that, okay, it's not being quoted in the market, that, okay, this is a quoted price that must be sold. Not like a shares. You know, for shares now, they have their own quoted price in the stock exchange. But for a car now, for example, if I want to sell my own second-hand car, so far there is no quoted price in it, but there should be a value for that particular category of asset that I can quote. Not that I want to sell a Toyota car now, I will now be quoting a price for a Rolls Royce. It's not done. Even though there is no quoted price in it for it. But in a real sense, because of that category, because of that level of asset, we all know that, okay, this car is Toyota 2008 model, and presently, this is the general market value for this. You can also consider that as well. The input 3 talk about unobservable input. This involves the entity using its own assumption about the market. Examples of these are forecast and historical volatility. So this has to do with companies using their own personal assumption as the value of their assets. So we have valuation techniques. There's cost approach, there's market approach, there's income approach that is being used to value an asset. All these are just written, you have it there. But it's also a standard that can be tested either alone or they can test it in addition to a particular question. We'll be looking at some of the accounting standards that they make use of fair value as their recognition price. That okay, before if you want to recognize subsequent recognition price, we are going to make use of fair value to recognize it. So when we talk about the likes of IFRS13, IFRS16, we are going to look at it and get them. So advantage of fair value, relevant to users, decision, consistency between companies, it can be used to predict future. Disadvantage, sometimes it is not reliable. It will not be reliable if you are using that kind of level 2 whereby there is no quoted price, we are using our assumption, or where a particular company is using their own assumption to value their assets. Even if the asset is of the same category, I, in my own company, we can decide to value our own asset at a particular price. So, time consuming, cost constraint. All these are the disadvantage of fair value. So, do you have any question to ask on this? Any question?
So the fair value, is it mostly theory?
Yeah, it's theory. It's theory.
That's good.
However, it's not like a standalone accounting standard. There are some accounting standards that make use of the fair value. So when we get there, you will see there are subsequent recognition. There are subsequent recognition in terms of value, like IFRS40 or IFRS16. Initially, it will be recognized at cost, while subsequently you can either make use of the fair value measurement or you make use of the cost less impairment and less any form of depreciation. Yeah, we will get there. When we get there, we look at it. But IFRS13, its fair value is a very simple accounting standard and is written. But they can make it not written depending on how they want to ask the question. But they will be very clear on what they want you to do. It'll be very clear. When we are treating some other accounting standard and make use of the fair value, you will see it there. Madam Ifunaya.
Yes, sir. Please, I want to ask another question, sir. Okay. I was studying a subject, a paper, and I was made to understand that as in a kind of this fair value, it has an alternate method, which is the proportionate method. I don't know if the fair value and the proportionate method are they two kinds of methods for valuing an asset, or
you are talking about the group account, right?
Yes, sir. Group account, yes, sir. The non-controlling interest. Yes, sir.
Yeah, yes. So depending on the valuation that the parent company wants to use, if they want to make use of the fair value, they will give you the fair value value that you are going to use. But if you are not making use of the fair value, you will be the one to calculate the proportionate value by apportioning the subsidiary equity. So the value that belongs to the NCI will be the proportionate value. Why if the parent company decided to use fair value, they will give you a fair value figure already. So there are two different valuation methods. They are not the same thing. And if you look at how they are being solved, you will notice that they are different. If you are using proportionate, you'll be the one to calculate the portion of that subsidiary based on the group structure percentage. So you calculate the portion that is going to the NCI when you are sharing the subsidiary assets.
Thank you so much, sir. I'm grateful.
All right, Mr. Said. Mr. Said.
Okay, yeah. Thank you so much. I really appreciate. And what I just want to ask, it's not the fair value is well gotten. But what I want to ask is out of context, but permit me to just put record straight at this point. I want to confirm
All
the
right.
the group account that we started, we only had a class on it, and the part two was
Okay.
not it has not been done yet. I just want to confirm if I'm having the right perspective, or it has been done and I did not know. Thank you.
So on that group account,
People taking
uh, what do you say?
people are taking group account is Mr. Ignatius.
Yes, I'm not the one. Yes, I'm not the one taking group
Yes,
account.
I know
However,
it's not the
the
one, but I
person
just
taking the
want
group
to confirm
account,
why we've not seen it.
yes, I know. The person taking the group account is as a result of maybe is busy presently, but it will definitely take you the remaining part. It take you the remaining part. And also, if you
Okay.
notice, the Google Meet account we are using to take this online question is actually different. Like the one I'm using now is for Taufik, Mr. Taufik Abiri. While there's another one for Apex. So if you go to Apex page on YouTube, if they are, even if they have taken that second page, that second part of the consolidation, you will see it there. You will see it on their page. But I'm not sure if they have taken it. I don't think so. If they have taken it, they will notify you.
Okay, thank you so much for the feedback. I really appreciate.
All right. You can as well check their page to confirm. You can as well check their page. Or you should reach out to what is the name of this man? He's the one taking the group account. Do you have any other question? All right.
Okay, sir.
In case of no question, we are going to call it today tonight. I will send the note to the
Okay,
group
sir.
chat now. And
Okay,
also,
okay.
for the person that just joined the group, I will share the IS23, both the question and the solution, so we can all go through it.
Good
Thank you
evening.
very much for tonight.
Good evening, sir.
Good evening, Amity.
Okay.
Good
I'm so
evening.
sorry, sir. I just want you to finish before talking, sir. I also just joined the
Okay.
group. I also just joined the group
All right.
yesterday, so I will appreciate if I can get some of the materials that has been shared ahead before, so I can be able to
All
catch
right.
up.
No problem. I think we have up to 3 volunteer taking FR. So I'm going to reshare my own. This is the second standard me I'm taking them. I've taken them
Okay,
at
sir.
IS23, and this is the second one. So I'm going to reshare the two documents. However, you can as well reach out to any of the class members that have the previous document too, because I may not have access to the previous material. So I only have access to my own material. So you can reach out
Okay,
to
sir.
anyone if they can help you to reshare it, or share it with you directly to your DM. Or when you have the lecturer, you can ask them. But my own paper, I will reshare the two of them now. I think you have 3 files now. One file for the standard IS23, another one for IFRS23, IFRS13, and the Excel sheets that we used to solve the question. So I will
Okay,
share
sir.
everything now. By God grace, next week we'll be looking at IFRS 5. So
Okay,
before
sir.
that time, I'll try and share one particular link to us, just a short video that we should all watch ahead of that time, so that we can have an idea
The
of
prior
what
knowledge.
IFRS out. Because even as at last diet, IFRS 5 was tested. I think out of the standard we did last diet that I personally take the class, 3 or 4 of them was tested. IFRS 5, IS37, I think one other one, 3 of them were actually tested. And even if it's 15-mark question, if you are able to get something, maybe out of that 15, you are able to get 12 or 10, it's going to go a long way. And I wish every one of us the very best of luck this coming exam. So let's call it a day tonight. I will share
Thank
the
you so
group.
much, sir.
All right, thank you very much,
Thank
and
you
have a
very
good
much,
night
sir.
rest. Don't be angry for the other. What do you say?
Thank
Hello,
you,
sir.
sir. Thank you so much, sir. God bless you.
All right, thank you very much.
Thank you, sir. Good night, sir. Thank you so much, sir.